In your working years, investing's pretty straightforward. Save consistently, stay invested, and focus on long-term growth. But as retirement gets closer, the rules start to change. Today, we're talking about what should change, what shouldn't change, and some of the mistakes investors make as they move from growing their money to spending it. As retirement gets closer, some investing principles remain the same. Many investors think that they need to completely overhaul their portfolio once they reach their 50s or 60s. That's often not the case. Long-term growth still matters because retirement may last 20, 30, or even 40 years. Diversification remains one of the most important risk management tools available to all investors. Trying to time the market is no more effective at 60 than it was at 40. Investment decisions really should still be driven by goals and by strategy, not by headlines or short-term market movements. Regular portfolio reviews and rebalancing, they still remain as important regardless of age. Maybe the way you rebalance, the way you restructure is a little different, but constant maintenance is a good thing. Retirement doesn't mean you automatically just eliminate stocks and equities out of your portfolio. Most retirees still need some level of growth to help combat inflation over time. If some of the most important investing principles stay the same, what actually should change? Well, the closer you get to retirement, the more your portfolio needs balance, growth, income, and risk management. The purpose of the portfolio begins shifting from accumulating and building this stockpile of money. Now it's moving towards future retirement income. We talk about the shift from accumulation to preservation and distribution. Asset allocation becomes more important because retirement losses can be harder to recover from. Time horizon, risk tolerance, and expected income needs should really play a larger role in investment decisions now that you're getting close to retirement. Diversification needs to extend across stocks, bonds, and cash rather than relying too heavily on any single asset class. These are really critical now because you need to ensure that the investments stay aligned with your retirement goals. In retirement, things can change quickly. Health can change quickly. Life can change. Family can change. You need to know that we're constantly building and managing and adjusting your portfolio. As you adjust your portfolio for retirement, it's not just about owning the right mix of investments. It's about understanding the risks that become more important at this stage of life. One of the biggest risks facing pre-retirees isn't necessarily a market crash. It's a risk that they haven't even heard of or thought about. It's called sequence of returns risk. Sequence of returns risk refers to the impact that the timing of market losses can have on retirement outcomes. Two investors can have similar long-term returns and achieve dramatically different results depending on when the negative returns happen. Market declines just before or shortly after retirement can be especially damaging. Warren Buffett has this great saying, what are the number one rule of retirement income or retirement investing? Don't lose money. Rule number 2, don't forget rule number 1. Withdrawing money out of your accounts during down markets can really lock in losses and reduce your future growth potential. Think of this. If the market drops 10% and I take out 5% to live off of, now we're down 15%. What happens when there's another bad year and I take out another 5%? Well, the question is, now I'm compounding and locking in these losses at a greater rate. That's sequence of returns risk versus if I retire and immediately the market goes up. And then I take 5% out, but it made more than, so I'm good. So if you're on the good side of the timing, it's great. If you're on the bad side, it can be pretty bad. The years immediately surrounding retirement are often the most vulnerable period for this type of risk. This is one reason why portfolio construction becomes increasingly more important as retirement approaches. Understanding these risks, it's important, but knowing about them and avoiding them are two different things. Most investors make one of two mistakes: taking too much risk or not enough. Some investors become overly aggressive in an effort to maximize returns before retirement. The last 2 to 3 years, they say, I'm going to ramp up. You should ramp up your savings. You should ramp up your contributions. However, it doesn't mean you want to ramp up risk. Other people become overly conservative and they move everything into cash because we're afraid of losing money before retirement. That fear is fair. It's just not prudent to react that way. Holding excessive cash can create long-term purchasing power and inflation challenges. We all know inflation is high and it's staying high. So keeping it in cash means I'm losing to inflation every single day. Some investors fail to rebalance and end up with a portfolio that no longer reflects their goals or risk tolerance. How you invested at 40 is different than 50, different than 60. Again, not wildly different, but we do start sliding that scale towards preservation-minded investing. Emotional reactions to market volatility often leads to really poor investment decisions. Retirement investing is about finding the appropriate balance between growth, income, and protection. The good news is that many of these issues can be addressed before they become problems. Steps you can take right now to evaluate where you stand are this. Review your current asset allocation. Determine how many years you are from retirement. Evaluate whether your portfolio is still built primarily for accumulation or for future income and preservation. Maybe you should stress test your retirement plan against a really bad or significant market decline. Make sure your investment strategy aligns with your retirement timeline and goals, not just what's convenient for the advisor or for the algorithm that's being sold to you. As retirement approaches, investing becomes less about chasing returns and more about making sure your money can support the life you want to live. We can help you review how you're invested and where you may need to adjust. Just go to our website, michigansretirementcoach.com, or click on the links below.